Welcome to Shareholders of a Better World, brought to you by TBLI Group. At TBLI Group, we have an established reputation as an organization dedicated to building the ecosystem of global sustainability and impact investing. We're doing this through educating, advising, and facilitating transactions in global sustainability and impact business, as well as capital solutions for private companies, family offices, and fund groups. For nearly 25 years, TBLI Group has created a vertically integrated ecosystem of education to action through TBLI conferences and TBLI consulting. More about our company can be found at tbligroup.com. This webinar is brought to you by TBLI Foundation, which hosts educational learning experiences dedicated to a better planet. Through the foundation, we build sustainable communities by sharing the people and the experiences making a difference to so many of our lives around the world. Our weekly podcasts bring impact thought leaders that are doing and not only chatting. Now let me introduce my guest today. Good afternoon from our studio in Amsterdam. TBLI webinar, Shareholders of a Better Planet. Our episode 14, and the subject today is impact measurement, and we are honored and privileged to have two uber experts. One from Brazil, Sweden, and Portugal, Angelica Lips da Cruz, CEO and founder of INNORBIS, and Jed Emerson, founder from the Blended Value Group, who got up extremely early today from being in Denver, Colorado. So thank you very, very much. I want to thank everyone for coming. I'll try to briefly greet everyone. Ricky, Simon, Jonathan, Maria, Jose, Eden, Tom, Jonathan, Albert, Paul, Paul from Bangkok, Sawadee Cup, Terry, Gerrit from South Africa, Francesco, Champreet, Lydia, Delcia, Nanoko, Simone, Marco, Tal, Samuel, Hal, William, Marcel, John, Leslie, Eric, Arvind, from Thailand, Sawadee Cup, Fishin, Jim, John, Laura, Arlo, Simon, Cynthia, John, Glenn, and quite a few others. There's actually way too many. This is one of the biggest lists we've ever had. Thank you all for coming. If you have a question, just type it in the open question area, and we will address that after the presentations. Use the chat area just for chat among yourselves. I want to introduce Jed Emerson, who's a very old friend. He's not that old himself, but he's an old friend to me. One of the pioneers and thought leaders in the impact investing space. Jed, for those of you from another universe that haven't heard of you, who don't know who you are, briefly tell the audience who you are, what you do, and what is your relationship with the whole impact space.
Thanks very much for having me. It's a pleasure. So Jed Emerson, I actually started my career in social work, and in 1989, 1990, collaborated with George Roberts of KKR to launch RedF, which was is a venture philanthropy fund investing in social enterprises, and in that capacity convened what I think was the first working group to formalize a methodology to calculate social return on investment for capital. And out of that work, began doing more and more work with for-profit, mission-driven investors. Most recently, I've spent about the last 10 years working with family offices, doing total portfolio management. So looking at the deployment of philanthropic, near market and market rate capital in a coordinated way. And in that regard, have spent a lot of time around the metrics issue. I've published 8 books on different aspects of impact investing and social entrepreneurship. And the last book is The Purpose of Capital, which explores what is really the fundamental question, which is why are we doing any of this? And it's a pleasure to be here today, and I'm looking forward to the conversation.
Okay, Angelica Lips da Cruz, a recovering banker and social entrepreneur. Tell the audience briefly who don't know who you are, what you do, what is your relationship with impact measurement, and then after that introduction, you can start your presentation, or Sam will start that.
Thank you. It's a pleasure to be here with all of you. Yes, my background has been for more than 20 years now in the financial sector, but before there, I was working for large companies. So I have both sides, I would say, at the financial sector. I was working for large banks, very large banks, Citibank, SEB, and Erste Bank, and in very I would say heavy positions, taking care of credit, of risk, of relationship. I was handling large companies around the aspect of assets, for example, and the impact in the society. I was reconstructing companies, handling 80 financial instruments, for example, like syndicated loans. So I have a very practical background. I'm an economist and I'm very interested of macroeconomics. And 4 years ago, I was so frustrated that I decided to drop off the banking world because we need a neutral and independent player and a very heavy system and a different approach to handle the complexity and the challenges that we have in the world today.
Bravo. Sam, can you start that presentation, please?
Thank you. I will briefly talk about a couple of important facts about impact measurements, just giving you all a teaser so we can start a good conversation. So impact metrics, what are our choices? What is happening out there, and with all these ratings and with all these dialogues around ESG, and is this leading away or is this leading us astray? So let's have a look at this. It's been a research that we've been doing for many, many years now, and that the market needs to understand the challenges around. Slide, please. The state of course today is that the data is ruling. And for some people, that's very objective, but we need to understand that I would say that's not a quantity. Those data is uninterpretable. It's a lot of volume. There is a lot of data out there. So some people that would say, oh, there is not enough data, that's a lie. There is a lot of data, but you need to handle the complexity, the correlation around it, and quantify it. So let me give you an example. If you think a company can be assessed by talking about the revenues lines, that's, everybody knows that's, you know, not sufficient. And that's what's happening now with data. So people talk about emissions or about a certain number, and that's not a quantity or a progression step to see where actually the players are improving themselves into the impact field. And I'm talking about all the sectors, and especially the financial sector. So, for example, it's quite impractical with that data. There is no guidance of how do you manage that volume and these statistics. The statistics are just a way of describing things, but they are not looking forward to see what's going on. Can we actually reach these targets? So that there is a need for identification here and to understand and connect with the patterns that we are seeing, and that has not been done yet. So the results at the moment, and what we have there, the biggest players in the market on the ESG field, they have backward-looking systems. What does that mean? It means that they just look into accounting and the reported data, and they cannot see the steps of progression. That's literally what it is. And even worse, all the efforts that a lot of people here are trying to cover are not sufficient, or is impossible to do if you don't have a common metric. I would say the differences between ratings, because ratings are not measures and numbers are not quantities, that's a huge one. We need to understand that norms, for example, they have a huge variation, and that's not captured by norms. The scores, for example, that are out there, that's just not standing for real the facts and the real world that we want to add up here and to have an impact on. So the complexity is quite high here. Slide, please. I want to also to say that when I'm talking, I'm not going to go into the differences between impact investment, ESG investment, and what's, all of that. For me, it's the same thing. We all aim to the same thing, which means that there shouldn't be any profit if you are destroying human, social, and environmental value. That's the fact. We have a lot of actors today that have got already the mandate not to do harm. We have yesterday Europe passing the taxonomy, the new taxonomy that will allow a little bit of more transparency in the market, but the fact remains, and so we are going to work with the SDGs, the global goals, the TCFD, all of it as the same language for impact and sustainability. The current market, for example, with the big players in rating, I would say the biggest problem with them is that there is no reward when you leave a negative choice. Okay, so many of the large players today, they exclude fossil or exclude some of the items that they believe are not ethical, but the ratings and the price of capital is not accommodating that. Another one is that the big credit risk companies, they are never considering ESG aspects as a main driver for these credit ratings, which means it's not integrated. There is nothing that integrates these factors that are very crucial and material into the equation and the financial capitals markets. I would say we need measures that work together with standards. We know that, but we need to get there. And to get there, we need to see the structures and the hidden information behind the data so we can compile better information decisions. Slide, please. Just a quick note to say that today we assume we need centralized policies and designs, and there is, in fact, a disconnectivity out there. And what we are aiming for, and this is a world of the digitalization, I'm talking about the internet and the global information out there, that's a horizontal connectivity, that's a distributed system, and we need to align that. Otherwise, we are really challenging the ambition and where we are technologically speaking today in 2020. I would say the ecosystems are so multi-complex, they are so in relationship that the difficulties, this what the market calls the unknown after the 2020 crisis now, it's silly. I mean, we know what it is, but it's not priced into the financial mechanism. So the trust is gone. So what if we could map trust and relationship in a common metric? Because the data alone is not doing that job. Slide, please. I would suggest that a common metrics, they go from what is a scale of achieving the easiest things or the hardest things, and then you have a rule that everybody can apply to, with the complexity of these goals, because there are many. You cannot give away the climate change for social aspects or the opposite, so, or vice versa. So it's very important that we work with all of them in a multi-structure and together. Slide, please. Here, what you see is a very quick demonstration of the first strata. It's a reliability that is not sufficient, 0.67. For example, that's what you see in many of the ratings and the data information out there. And it's all plotted everywhere. It's like statistics, right? So when you start working with a stochastic model and the deviations, and you start getting the stratas, the reliability gets higher. And I'm going to show you how we have worked within INNORBIS to get to this instrument equation. Slide, please. Very quickly, I would like to show that when you connect the companies and the investment community, the countries, the citizens, I mean, people, we are people, right? And with the regulators, with the common metrics, you get actually the integration of everybody's position within one platform to cover this transition. And that's very important. Otherwise, we are still working in silos, and we know that doesn't work. Even the banks are starting to change their strategies because it doesn't work. Slide, please. So what do we see here? This is just an example of one of the tests we did to cover for the sector healthcare. And you can see what I'm talking about, the stratas, the standard deviations, where we have Biogen sticking out greatly. So if I would have done just a rating and a ranking, this wouldn't have showed here. But I can see that there's something going on, and therefore Biogen was a great spot. We spotted more or less 4 months before Dow Jones ESG rating did, with a reliability of 0.96. And you can see that we cover uncertainty levels, which is normal out there in this data. Some data doesn't exist, and you need to see the pattern so you can cover for that separations and the positioning of all the players. Slide, please. So, in other words, this is another example of how we can use a common metric to really state why do we mean that predictive models can move the market towards impact and sustainability. Because if you can predict, you can actually earn a lot of money. And that's what we are showing here with this direct index. And it's actually going from the numbers to the quantities that we are talking about. And therefore, when we spot these companies, and this is just an example with partners that I have, and a great team around the risk premium, for example, when you combine that, the content of sustainability and impact with the mechanisms in the financial sector, that's a huge thing. That's a direct indexing. That's really good money allocation, I would say. It's a good example. Slide, please. So to conclude, I would say a couple of things that I would like to pick on later on. We really need to identify what's important. We really need to get into this common metric system. There isn't anything out there that is high reliability and that can cover from just numbers to the quantity. So we are building this. We need to verify the data. We need to have the relevance and what is important for the real world, right? So, for example, the world doesn't need to just create an economy, because we are actually having people dying. So there is a real world out there. And the common measures would help us with this quality assurance, the fair trade that doesn't exist today, a lot of greenwashing, and the objectiveness that we are looking for. It's powerful, it's rule-based, and the trust when you have mapped the relationship is amazing to see. And believe me, I've done many tests, I've worked many times with this data, and it's very nice. It's the data talks to you. I would say we have a mathematical measure model. We are looking to measure the sustainable development, the progressions, and that is what INNORBIS is for. It's the outcome of all that. It's a rise of a new global economy, and to actively, demonstrably, and accountably cares about its ecosystem. We are working with technology, with the energies and this motive to really fulfill human destiny, and we are stewards of the earth. I will thank you, and we can start.
Thank you, Angelica. Before I start taking some of the questions, I wanted to ask Jed, your latest book, The Purpose of Finance and Investment, which I've also been asking pension funds, and that, why are you doing ESG? Is it to be part of the club, the fitness club, and never exercise? What has been the reaction of the financial sector from your book? Because you're addressing not specific, light reading, nerdy finance stuff, what Angelica was talking about, which I love listening to, very nerdy finance stuff on a nice hot day. How did the financial community respond to your book?
Well, first off, let me say the book is free. So if you go to you can download a free digital copy of the book. So I'm not shilling the book. I think part of the challenge is that it's as Albert Einstein said in describing the theory of relativity, it's actually very simple, but that doesn't mean it's easy. And I think that when we talk about finance, we talk about investing, it's very easy for us to get focused on issues of how do we create capital that conforms to the existing structures to distribute it as investment vehicles, products, firms and funds. How do we make this all work? And the fact is, we all are kind of grappling with what the Buddhists call the illusion of separation. This idea that you can consider economic performance in the absence of considering environmental and social factors. And in truth, value is whole, it's non-divisible. And what we have created is a bifurcated investment frame that asks us to believe that you can do either or, that you can do good or do well, but you can't do both and. So the reason that I think the financial community it gets stuck is that we kind of start to wrap ourselves up within this bifurcated assumption of the world and of value, when actually we need to step back and really think about what is the fundamental purpose of the capital that we are stewards of, and how do we then deploy that on terms that optimize the total value potential of that capital. And then, as Angelica was just saying, how do we create metrics frameworks that can capture the total value possibilities that we're actually trying to manage for? And so when I raise these issues of purpose and meaning in the context of investment and finance, people say, well, the purpose of capital is to make more capital. The purpose of capital, when I was in business school, we would used to teach people that the purpose of capital is to seek its highest and best use. And that was a function defined by the risk, return, and liquidity, profile. The most money that you could make for the least amount of risk and the shortest duration of liquidity was the optimum piece. And I think the element that's come into this in the last, let's say, 20 years has been the realization that actually impact is the other element of performance that we need to be considering. And when we begin to take that into account, it really challenges a lot of our fundamental assumptions about how to manage wealth and toward what end. And then, of course, how do you assess the performance of that capital?
Angelica, you're asking basically the financial sector to take a Hippocratic oath of do no harm with your approach. You came from the financial sector. Maybe some of your former employers are actually watching this webinar. Let's hope so. How has the financial sector, or the financial alpha males and females, responded to what you're doing?
Well, it is true that they say we need to make money. That's the purpose of a business. And I would say it's not only the financial sector, it's the way we have construct our businesses, right? Like a limited company, or also the purpose is to create more money, or to work on the increase, the growth. But then I would challenge, what is the growth actually? Because since the 70s, we've been creating a lot of growth. It could be called the GDP, it could be called the profit and loss, it could be called more equity or the market capitalization. For what? I would say we need to understand that if it's not real, we cannot eat money, right? So we need to use the money as a tool to be well, to buy our medicines if we need to do that, to buy our food, right? So I think the crisis we are currently experiencing, it's really telling us, get together, care about each other, have empathy. And I think a lot of people don't have that. And that's a problem. Actually, not in itself the financial sector that is actually providing a lot of capital to companies as they require. But the problem is that the mechanisms don't integrate what we were talking about, the impact. I'll give you an example. When I was handling these large corporations from a credit perspective, of course you look for governance of the company and for the off-balance sheet items, but these are not integrating, for example, in the risk rating today at any place. I mean, if some banks are listening and tell me, oh, we do have green loans, I'm sorry, you're just discounting, you could that anyway. Okay, so the question is, integrate that in your field. When you issue a bond or when you issue a loan, you have to have criteria and follow up on those that cares about the impact in the environmental issues, in the social aspects, in every aspect that is real out there. So I would say that's something that I've worked a lot from the inside, and it needs to get more space. So, in other words, all these ESG managers listening to us, or people working for sustainability, they need to step up. They need to be core business, not just another department in a silo.
Yeah, but just to briefly, you're saying that people should have more empathy. So we shouldn't be teaching all of this measurement stuff, just teaching empathy to the financial sector. I'll let that hang for a second about it, because I did want to get back to Jed. I hear lots of times from institutional investors who claim to be impact investors, well, the measurement and the reporting is not really good enough for us to start. When it gets better, we can do that. Do you think that they're serious, or are they curious and they're just using it as an excuse not to do anything?
Well, I think it's probably a combination of all those things. When we talk about this, I think it's really important to put it in historical context. And a lot of folks kind of assume that the financial metrics that we use to assess performance of companies were kind of, handed down from God, fully formed. But we have to remember that it was really only just after World War II that we saw the creation of FASB and GAAP and other kind of regulatory bodies that really defined kind of like, how are we going to understand financial econometrics, and what does that mean? And then in the United States, it was in the 1970s with the creation of the EPA that we first started seeing companies report out on environmental performance in any kind of meaningful way. And then it was in the 80s when you started seeing people focus increasingly on the social element and trying to understand what that is. And so we're really at a point where we have a variety of different frameworks, of different perspectives, different lenses, if you will, that various investors, depending on their interest and orientation, are bringing to this work and practice. And so now is actually a great time to kind of step back and see, how do these different elements integrate themselves? And to what degree do we really need to have the right kind of numeric answer to a question? I think that a lot of the motivation for, let's say, pension funds to get involved in these areas and to begin using ESG metrics has really been one of self-defense, and recognizing that if they're not considering environmental, social, and governance factors, they're really leaving themselves open to off-balance sheet risk that will affect their ability simply to make more money. That increasingly we're in a world where if you're not looking beyond the numbers, you will, in essence, underperform over time. And if we look at the recent fires in Australia and the amount of expense that then represented to the insurance industry, you begin to get a sense of what that means, much less when you place it in the broader context of the climate crisis and how that will affect the fundamental business models of the companies that people are investing in. And I think part of the question is that people get so wrapped up in trying to get the right answer and quantifying everything, when in fact, the greatest assistance, I think, of a lot of these metrics is to help us think differently about our core and fundamental business models, help us understand whether we're directionally accurate and moving in the right directions to be able to really create companies that are sustainable and creating value for the long haul, because profits and profitability really is a byproduct of optimizing value and performance. And so as our understanding of what value and performance means evolves, our understanding of the financial implications of all of this relative to the analytics, the metrics, the standards of practice comes together in a whole different way.
Angelica,
Very well said, Jed.
Yes, very well said. Thank you.
Can I pick on that?
You can. I want to ask you a question, though,
Yeah.
because there's a lot of questions below that, but I still want to, try to address some of the questions I had. Everybody, since TBLI has been around for the last 25 years, every single rating agency, analyst, service provider, they all said, we have the best system. Nobody said we have the worst system. So you're saying you have the best system. When basically what I also hear, and also what Jed is saying, it's really more about being a mensch, values and empathy and things like that. It doesn't really have much to do with the measurement system. So if you could address that,
Okay.
I'd be very, very grateful.
Okay. Well, I didn't say I have the best system. I said we are building it, and we are building it together. The common metrics is something that you have to do together with all the stakeholders. And that's addressing one of the points that Jed was talking about after the Second World War, was actually the time when our productivity and the real value started diversing from each other. So the people were getting less wealth, put it this way, the distribution of wealth, and the shareholders getting all of it. So what we are seeing today is actually the failure after the Second World War to have everybody happy and with a happy life, right? Because the distribution has not happened. So that's actually a starting of a failure of the way we see the world today, with the shareholders owning everything and thinking that, oh, it's enough with 10% innovation of the company, let's invest on that. 10% is not enough. And pension funds the same. If they say, oh, I have invested on ESG 10%, or on a bond that is a green bond for 10%, that's not enough. It should be 100% actually. So I would say, no, we are not, we don't have the system yet, but the common metrics refers to all the stakeholders, to all the people around. So it's the individual, it's the company, it's the regulators, the markets, it's the operational location, it's all the locations and regions around the world that are not equal. There is no such a one fits all. It doesn't exist. So in the Nordics, you have a lot of water, but you don't have that in another region in the world, and that is creating a war. And then there is a company that goes and buy the waterbed. I mean, what kind of shareholder economy is that? That the commons are not to be owned. And let me post this as well. I'm not a communist, okay? It's not that. It's that there is a failure, and
we wouldn't mind.
Yeah, we are failing on that. So the metrics, I would say there is nothing working out there, and we are building what we are doing here. We are building it together with, let me pose a couple of things here. So Ben Wright is the father of measurements, and these statistics and these ratings are not addressing the complexity that we need to work with. So we have an unique method to work with that, but that's a long journey to go. We have some tests. We have already some very good products out there working together with our partners, but that's just a start. I would say it's requiring a lot more, and it's not only about the money. Of course, it's to put the money to work for the people, right? To work for the whole industries.
Okay, I'm good. We have now the largest list of questions at this time that we've ever had. So I need to get through this within the next 6 hours. So I'm going to start taking questions. So Tom wants to know from you both, what is the real difference between the current ESG model and the earlier triple P model? The fundamental loss of truth and trust in today's social climate is a strong factor when quantifying the sustainable performance of companies, societies, or nations. Are such factors already captured and evaluated in any ESG model? And has the credibility of rating agencies remained the same with the introduction the ESG model, or has it changed? So Jed first, and then Angelica.
Well, I think the answer is yes. No.
That was quick.
I think I think what we need to recognize is that these are all different lenses that we can bring to our understanding of value. And where you stand depends on where you sit. If you are a private investor, you're going to be looking for a different kind of risk return impact profile than if you're a public securities fund manager, let's say. And so I think we need to recognize that, you know, ESG speaks to like one lens. SRI, socially responsible investing, is more of a values-based piece that historically is focused on how do you take bad things out of your investment portfolio. Impact investing really evolved in the 90s by name, if you will, as a result of asset owners saying, I want to draw as short a line as possible between my investment dollar and community or ecosystem level impact. But these are all really, if you think about a portfolio and you think about a capital continuum, as you go across that portfolio, you basically have you know, an option to invest in different strategies in different forms.
Angelica?
Yes. Well, let me pick in a different perspective then. And remember, I'm an old accountant as well. So what if we have...
Young accountant.
What if we have just one bottom line? What if that bottom line, doesn't matter if it's called, you know, A, B, or C for the impact and sustainability, where you can actually calculate all of those factors. That's what I'm talking about. So the factor analysis, the material ESG or triple B or sustainability or you know, the SDGs has 233 official indicators. If we capture all of that in a common metrics, and I've been addressing in the question, what is quantification? And I'm saying there is nothing out there. INNORBIS works with quantification such as the way that our, you know, Ben writes, and then the measurements, the scientific measurements describe what's a quantity, so we can address that. Now, when we have that, and all of the stakeholders around that metric, then you build trust. Then you can really see the impact and what is happening with that company, for example. I would say the credibility would get much better, and never mind a rating agency, you see, because everybody would be able to see the development going forward. I mean, we've been trying that for more than 20 years. We know that the green accounting and all of these models and ESG as well, but we need now something else that is working, and that's exactly the quantification of the development steps.
But I think this is a very important point, is that where we have moved is from a place of saying the triple bottom line, we need to focus on that. But that still leaves the value proposition separated. And the ESG framework still leaves the value proposition separated. And I think the point that you're making is that, in fact, there is a single bottom line, but it needs to be reflective of all the components of value creation in order for us to really understand what the nature of that value looks like.
Correct. Very well said. That's exactly it. We need that. Unless we have that, we will still rate globes and stars and ESG, and then there is a dialogue, and then you don't implement, or you subjectively implement into a pension fund. That's not supposed to be there. It has to be integrated. Otherwise, it will never work.
And I think part of the challenge is that people confuse a good metric with the actual performance that metric is trying to represent. And that the risk is, as Martin Luther King Jr. said, we're in danger of having guided missiles and misguided men. But the metrics really are just guideposts or guardrails, but we still have to look up and understand where we're headed and why we're going there.
That's very good.
I'm going to, because we're getting so many questions, I'm going to try to address them. So I'm going to go one-on-one. So Rakesh had a question for you, Jed. What makes up these common metrics what are they and what do they actually mean?
Well, again, it depends on which framework you're operating within, what your asset class is that you care most about. If you're an entrepreneur, the metrics that you're wanting to manage to are probably going to look very different from a public securities analyst who's trying to look at a publicly traded company. And so, again, I would argue that depending on where you stand depends on where you sit. And so there's a variety of different approaches, IRIS plus, the SDG frameworks. I mean, there's so many things out there that we could talk about in terms of, the right metrics framework. But the point is really one of which one is most relevant to your understanding of the value you're trying to create. And I think that that's part of the issue, is that these all get kind of jumbled together. And then people come in and they look at them and they say, well, this is very confusing. Are these all the same? Are they different? We need to begin with what is the nature of the value that you're trying to manage for, and how do you understand that? And then which of these frameworks help you in advancing and managing for the optimization of that value you seek. And this is why when we start talking about stakeholders, when we talk about the commons, there are so many elements of this that are outside of our traditional definition of what we're accountable for, that we need to reassess the whole conversation each time we move forward another step in order to make sure we actually are moving in the right direction, that our community, that our stewards of capital, and that the planet really requires.
Thank you. Jan, who has the same name as one of my favorite singers from The Doors, Jan Morrison. Angelica was clear about the distinction between statistical analysis and measurement. It is a breath of fresh air to hear her speaking about this. How does impact investment as a field and community pivot and make greater use of this approach, and therefore more frameworks that are actually useful? Angelica.
Thank you. Well, I would say I'm very happy that we have already started the work for 4 years ago. We have been very heavy on that. The fact, let's put one fact here on the table. We have not monetized sustainability or ESG, and that's a problem. That's part of why it's not integrated, right? We have not priced these values that should be valued, like the human, the social capital, the environmental, these natural resources, they should be valued. Today, we have commodities, for example, we trade certain commodities, but not all of them. I mean, what will happen the day we start trading the air we breathe and put that in the market? I mean, there is an interesting thing here to think a little bit outside the box and to imagine that exactly what Jan is asking. If we don't work with that, if we don't care about those investments and to really be with a purpose, I think business as usual will not be a good strategy, because the off balance sheets, put it this way, or the other aspects impact your business. And we are going to see a huge change now after 2020. We already seen that. Even though we have a lot of liquidity in the market, it's not helping anybody. So it means the way the mechanisms in the financial sector operates with are a flaw at the moment. P ratios are, a joke. It's ridiculous, and we need something else. We need something else than statistics. It's not working out there. So we need to pick on metrics that we are all involved around, I would say.
Okay. Jed, Montserrat Calderon, he had a question for you. What impact measurement tools do you recommend? But you mentioned there are many. I don't know if you have one particular one that you like.
Well, again, it depends on the asset class that you're talking about. If you're doing direct invest, I think the IRIS Plus and the impact management project frameworks can be very helpful in terms of dialing that in. But again, you're still left with a large number of metrics. So when you're doing direct invest, to sit with the entrepreneur that you're investing in and really explore with them, how do you know whether or not you're creating the value that you seek? What are the extra financial metrics and performance that you want to manage toward? And how do we create the smallest number of those so that you're not spending all your time reporting on 50 different indices is important. If you're a publicly traded company and you're looking at public securities, it's a different question. And I think part of the challenge is we've seen so much discussion about, carbon footprints and measuring this, that, and the other. I'm actually less concerned that somebody can numerically prove to me that they're right than I am that they can show me that they're asking the right questions as managers of companies and of capital, that they're really understanding the context that their business is operating within and the need to basically look beyond the numbers and the numeracy to see the real situation that we're in and how they need to be considering that with reference to how they manage on a day-to-day basis. So it really depends on, whether you're in an operating role, you're an outside investor, public security, fixed income, direct. I mean, there's just a lot of different elements that you'd want to think about before you would say, here's the right framework that we need to use to guide our work together.
Okay, thank you. Well said. Brian had a question for Angelica. Shareholders seek financial returns that often require C-suite decisions focused on gross top-line margins with a small focus on ESG for brand building and marketing purposes. How do we prevent Evian and Fiji water from shipping to consumers in downtown LA or New York or London? If we limit global competition and free trade, we could probably achieve that, but that's not the current economic thinking. Tax the consumer for irresponsible consumption, corporate for the same, or do we leave it to the consumer to change their buying behaviors?
Thanks for that. I think cognitive and behavior is a big one. I will mention Ostrom, a woman that was a Nobel Prize. She talked about the objective, the boundary objectives. I would say we all have a stake on this. You cannot just leave for a company or a bank to run things, right? So it is the consumer, but not only the consumer, it's the whole society together, right? Operating for the same purpose, which is not happening today. It's in silo, it's disconnected, and we have a extreme speculation, I would call it, in the market and the financial returns that are now upside down because of the crisis, which means that the stability of the markets are gone. And we knew that before. It was just that every time we were taking one more day. Now that stability is gone. So we know it's not working. We know the equality is not working. We know that the water waste or the management of that is not working for the whole purpose of our society. So how can I help you by saying that if you have a common metrics, and again, not only numbers and not only the raw data, you need to be able to see the patterns and where the progression is happening so we can make decisions, all of us, as a consumer, as a company, as a manager, as a C-suite executive. So I think the companies, to be honest with you, and I'm an expert on a couple of the industries, they will have to change their business model. It's not working. So instead of tracking sales figures, they will have to track the function of their product. They will have to track what is their service and is it helping out our society or is it just garbage? Put it this way.
Angelica, I'd say it goes back to your previous comment that I understood to be full cost pricing. And that if companies actually carried the full expense of the products and services that they brought to market, many of the companies that we see on the markets today would not actually be, quote, profitable, because the only reason they are profitable is because either hidden subsidies from the public or they carry externalities that then are pushed onto the public and to the planet in different ways. So if we had a better kind of pricing mechanism to really capture all that and hold that to the firm, a lot of these companies would find that shipping bottled water from Fiji to London is actually not a profitable endeavor.
Very good, because the price is incorrect, right? Let's take logistics. It's silly that you do the gig economy and you buy everything on the internet through Amazon, and then who is actually paying for the roads? Who is actually, is it the taxpayers? And who is actually paying for delivering back? Because for the consumer, it's for free, right? And that is the wrong price. You're completely right. And again, what I answered, it's the business model that is incorrect. It's not pricing. They track by sales, right? And in Amazon case, they are actually funding the logistics side with the cloud services that are profitable and not the logistics, because everybody knows logistics are not actually a lot of margins. And I believe we are going to see instead of a globalization that we saw in the 80s and 90s, we are going to see a retrieve to go for locals and to try to be self-sufficient. I think that's the trend coming on.
Thank you. Before we take the next question from Marcel, Sam had a question for the audience. So all of you, if you would answer this poll, we're always looking, what is the best time to do our webinars for our friends in America, Europe, and Asia, that all of them collectively could dial in. So if you could answer the poll, what's the best time for you, that would be very helpful. So Marcel had a question for Jed. There's a growing awareness that we must aim for the right goals. However, when the rules of the system inherently send us in the wrong direction, it's time to adjust the rules. Question: based on your experience, what fundamental changes to the rules are needed to achieve the desired goals? To quote Einstein, too, you can't solve the problems with the rules of the system that cause the problems.
Well, I think that, I mean, this is the fundamental question that's before us today. If you look at COVID, a global recession, depression, the rise of nationalism and populism and authoritarianism, and of course, the Black Lives Matter challenge, we really have to step back and say, well, wait a minute. Like, we have to take more of a systems perspective on this. We have to really say, how are these different things all actually connected? And if we think about our relationship to development of the planet and how that then connects us with the release of viruses that then get transmitted from animals and from ecosystems to ourselves, and how that then reflects and reveals the economic and social inequities of our societies. I mean, all of these things are obviously, wicked problems that are fundamentally interconnected. And so I would argue that the first thing that we have to do is bring a perspective to our reflection and our discussions that is systemic, that is regenerative, that is circular, that understands that this illusion of separation that we've been operating under and that we have created modern financial capitalism around is just at its heart fundamentally flawed. And so you first have to acknowledge that. If we think that this is just going to be a question of tweaking a little bit on the sides of capitalism to get us to the next level, I think we're fooling ourselves. And so the first thing that we have to do is recognize that the way that we thought about economics today in terms of modern financial capitalism versus economics in the original Greek, which is household management, and how do we provide for the household, we need to shift our thinking, and simply making that one kind of alteration in our approach to how we understand what we are doing, I think opens up then a whole host of implications around how we think differently about the firm, about capital, about community and the role of shareholders and stakeholders in that relationship. It just opens up possibilities that aren't really available to us if we stay within the current structure that says, this is my money, this is my wealth, and my gain has to come at your loss. And so we need to just fundamentally reconsider this. And quite frankly, this is why I ended up doing the last book on purpose and meaning and the why of capital, because after writing and co-authoring 7 books on how to do impact investing in social entrepreneurship, I realized that it really isn't a question of, do we have the right tools and practices? It's a question of, do we have an understanding of what are we at heart really trying to do? What are we trying to achieve? What are we trying to create as a community of practice? And so I think that's really where we need to start if we're going to get to any of the right answers that could take us forward in the future.
Can I add?
Please.
Yes, it's very good because
Please.
we have seen some moves in Europe to address what you're saying. It's not a tweak. It won't help. We need to change from, bottom up. The subsidies and all of these things have to go because today we know there is no open market. We know that there is a fix everywhere, and it gives better advantage for this or that and that region or this region. So we need to work on releasing that. Now, the European Investment Banking had done a couple of things. The European Green Deal is picking up, but we don't see that in America, for example. And I would say, today, the financial transitions have changed a little bit and will continue to change. I mean, Asia has so much to take, and the debt burden going up in the US and in many countries now, that will have a impact that I cannot even imagine. I've been working on that. I've been looking at that, and it's scary. So if we haven't done anything until today, we will be obliged.
Thank you. Elizabeth had a question for Angelica. Are there regenerative criteria included in these metrics?
Oh, I love that question. Thank you very much. Yes, we have a lot to do if you're thinking of regenerative and the whole circular economy idea that operates with taking care of the resources and going around, not linear anymore. That's spot on. That's how we operate. That's part of the theory that you put into this common metric, so you get a real value for what the progression is. Very good.
Thank you. Elsie had we're never going to answer all of these questions within the time frames because we've never had this many questions. So thank you very much. We'll try to address as many as we can. Elsie had a question for Jed, talking about optimizing value as an imperative for investors when value definitions exclude well-being for all. What gives you hope that business finance will shift from capital growth to whole system well-being as a performance metric?
I think there's a number of things that are happening. I think one is that increasingly investors are saying, look, we recognize that this is a different way of thinking about performance, and we're comfortable with that, and we want to hold you accountable for that in a new way. And so I think part of the key shift that's taking place, certainly in the private capital markets, is more and more individual asset owners are saying it's not enough for me to simply die with a bigger pile of cash than I started with. I want to understand that the money that I control, the money that I steward, actually is creating deeper value. So I think that's one aspect of the shift. I think also at the corporate side, more and more companies, I mean, we're just seeing this all over the place. This is part of the big shift that's taken place in the last decade. More and more companies are recognizing that even if their starting place is simply, financial return, in this world, you cannot achieve consistent financial return in the absence of considering off-balance sheet risk and opportunity. That we really need to move out of the previous way of understanding the value proposition of the firm. And I think as more and more managers recognize that, you're seeing more and more efforts to grapple with these fundamental questions. I also would argue that the generations behind us, I'm 61, and folks who are in their 20s and 30s, and even folks in their 40s, are really coming into their careers and their lives with much more of a holistic understanding of what it is that they're supposed to do. In previous generations, you worked to make money from Monday to Friday, and then Saturday and Sunday you did good, or you gave back to your family or your community. Many folks who are behind us come to either wealth management, corporate management, or civil society and public sector activities with a much more integrated understanding of value that they're wanting to manifest over the course of their careers and their lives. And as that shift takes place, you're seeing a response on the part of capital markets. You're seeing accountability on the part of companies and NGOs. You're seeing a real evolution in terms of people's understanding the value that we're trying to create over the course of a life.
Thank you. Cottle had a question for Angelica.
Thank you.
You mentioned the need for common forward-looking metrics to measure companies' ESG impact and how they improve their ESG performance over time. Numerous organizations are attempting to do this: SASB, GRI, GIN, PRI, the Impact Management Project, and the Impact Arena. Which approach proposed by these various organizations do you prefer? And if none of them meet your standards and you believe that your metrics are better, would you make your approach available to the public?
That's a brilliant question. Thank you very much for that one. Yes, the dream is to make it available for everybody. Let's talk a little bit about these companies. I mean, SAB is doing a great job. It is still accounting. They're trying to have the materiality in the accounting, so it will always be the backwards looking. It's reporting, okay? It's not core business. Now, GRI, GIN, PRI, these are shelf, so they don't have methodology. They just have a huge network, okay? So that doesn't work. And I can answer the next one as well. Msci Esg Ratings. These are just ratings. It's a ranking. It's a black box and a very expensive methodology that everybody knows is not working. So I'm seeing a lot of investors dropping off that, even though it's still the biggest one out there. But you know, ratings are not going to solve the problem. It's like, okay, how can you see that a company that is a number 1, 10, or 20 is actually progressing towards sustainability? It says nothing. So the rating is just pulling out numbers and crunching them, but it means just numbers. Okay, so quantities are different. So I would say yes, we are building. I mean, it was a decision I made. Instead of working with accounting standards like SASB and like other companies like True Value Labs does, and taking from an accountant perspective, we prefer the predictive, the forward-looking, and then we work with risk and real values, real quantities of these values, and that is the change and the why it's working for us and maybe not for them.
Thank you, Angelica. Jed, William had a short question. Where is the field with respect to actual inclusion? Let me be more specific, Black inclusion.
Well, I think that in the States, a lot of this, I think, comes down to the community level of how different communities are advancing various practices around diversity and equity and inclusion. I think in the US, you see a whole host of movements around community-driven economics. If you look at things like Ujima Project in Boston, if you look at Common Futures, which is identifying and supporting grassroots leadership in a variety of different communities across the US, I think a lot of folks are exploring various ways to advance that. I think the trick is, again, it depends on context and community. And so the right answer will look differently based on country and culture.
Thank you. David had a question for Angelica. It's a trick question. You're talking about a fundamental shift in humanity. So I'd like to know how fast, without being a world reset by COVID or a wild dreamer, do you think it will take to change the world, including 195 countries and 7.5 billion? That was the question. So how long would you think it will take to change the world, including 195 countries and 7.5 billion people?
I love that question. Thanks for that. It took us actually 50 to 60 years to do a lot of harm. So I believe we can do it quicker now to change. And let me give you some optimist figures here. We do have already 193 countries in our metrics. I'm very happy about that. We operate with a lot of open source data, like from the World Bank, OECD, and everything that is available there that is according to our requirements for the quantities. That's very important. Otherwise, you get media information, and that's silly. Don't operate with those data or with any any rating that would work with media information. That doesn't work, okay? So it's important to understand that we will do this together. There is no option. I'm an optimist, okay, but I think we can do it. I think it's needed to be the bottom up, as I'm saying.
Well, let me add to that and say that we really aren't trying to change the fundamentals of humanity. The aberration is modern financial capitalism that's evolved over the last 200 to 400 years. If you look previous to that, our understanding of community and of capital and of the purpose of economics has been much more expansive, has been much more traditionally inclusive of broader understandings and needs of the environment. If you think about indigenous traditions, of communities, if you think about the intentional community movements that have occurred over centuries, if you think about traditional privately held companies in Europe, they have historically taken into account much more than simply the making, the master wealthier than they are today. And so I think in some ways what we're calling for is a return to first principles of humanity that really has driven our understanding and approach of justice and economics and equity. And that's what we really need to do is pause and listen to the wisdom and perspective of generations that have come before in order to position our generation and generations to come to be in the greatest possible place for potential success to survive the crises that we've created because of modern financial capitalism.
Thank you, Jed. David, why don't you type in the website of what your solution is so people can look at that later. Vishen had a question for, actually this time, Angelica. There have been many instances where global impact investing firms have invested or issued financial instruments, green bonds, etc., microfinance institutions, even insurance companies. What these banks and companies do in turn is to give them out as microfinance loans. I personally don't think this is what actually impact investing is, because these banks don't assess the environmental or social impact created by the businesses who they give these microfinance loans to. I'd like to hear your thoughts on this.
Okay, that's a very good question, and you're posing to the right person. I was in charge of a lot of different business, from the microfinance to wealth and green bonds. Let me start by saying as well, bonds are a very small fraction of what the capital is. Microfinance is the same. The big chunk of the capital to be assessed, managed, and invested on is so much more. So to give you a perspective, bond stands for less than 1%. Microfinance is also a tiny thing, but it's extremely important. So microfinance would put people in a better perspective, in a better life, especially if they are like me, an entrepreneur. It's needed, and you need to do that with a very good quality lens. The social aspects needs to be there. I get very angry when people work with microfinance that is, with biased kind of risk criteria. Don't do that. So the risk criteria to provide finance, microfinance, is very important. Now, on the green bonds, there is a lot of greenwashing, okay? So let's be honest with that, and hopefully it will become better now, at least in the European, the ones that have to report in Europe in a year time. But the criteria, again, are not there to follow up on this impact. So it's still a lot of financial criteria like tenor, coupon, and rent, and interest rates, and all of that. But I do believe it's extremely important that we continue with those financial instruments. They are all very important.
Mauricio, active in Brazil, had a question for both of you, Angelica and Jed. As long as there are not an agreement on standardized metrics, any one of the many different certifications will probably continue to have little value, and greenwashing will be able to continue. What is your opinion on this? So Jed and then Angelica.
I'm torn. So on the one hand, yes, I recognize the need for standardization. And my concern with that is that what I think tends to happen is that you standardize to accommodate the existing system. You standardize to create conforming product, to use terms and metrics that already kind of like plug into how we're managing capital in companies today. And the whole point is we need to manage capital in companies differently. And so unless we shift both the framework and then the metrics, I don't know how we're going to get where we need to go. And so on the one hand, I appreciate all the work that so many of our colleagues have done in terms of the metrics conversation and standards. And at the same time, I think it begs the larger question of to what end. And so I think we need to be continually going back and forth between, you know, the application and the practice and the understanding of purpose and intent and meaning, and continually be dialing this in and calling the question of, is it enough? I mean, if you do standard SRI and ESG, that never rises to the question of, well, wait a minute, what are we managing for? Are we actually going to change anything? Or are we simply going to be reporting on our increasing decline? And so this is the challenge, I think, in this practice, and why we need to have different perspectives and tensions really playing out as we go forward.
Angelica?
Very good. Let me pick on the standard. A rating can never be a standard. So again, unless you create the quantities and put it there open source, which is what we are working on, with the right certification organ, that won't work. So that's a standard that has to become. We have standards and regulation in finance. Now we need the standards on the whole sustainability area. The best communication tool we have today, in my perspective, is the SDGs. But those correlate to each other. So that's not a standard either. It's just a lot of questions. So I would say I showed a picture with the disconnectivity and then a distributed systems where I can tell you my dream is that we will all be integrated into a system where we can have auditors everywhere. Let me give you an example. So INNORBIS works with Transparency International, which is the corruption data, but it's not enough. I need not only the companies to report, but I need the individuals to tell me, oh, it's true what they are reporting. So that kind of stakeholders interactivity and when they talk to each other in the same system that is transparent, that will address the common metrics and the new standards that we are looking for. And we are working on it.
I had a question here. It's an opportunity. Here we go. With investment in outcome. Which metrics can relate the financial governance, social, and environmental metrics with investment in education and its outcome? I'm asking this because we support a project where children from low-income parents go to international school in an emerging market. The education for each kid there approximately $5K. They estimate $600 would be suitable. Here into the cost of pupil is approximately that. Thank you for your which metrics can correlate the financial, governance, social, and environmental metrics with investment in education and its outcome? Does that exist?
Well, I don't know that anybody has connected the ESG with the education, but I'll say that a fundamental question that's kind of buried behind what you're describing here is that the notion of time horizon and the fact that investments in education, investments in children often will take 5, 10, 15 years, 20 years to really mature and come to fruition. And most investment time horizons are well short of that. And I think it raises this deeper question about how do we understand what is the appropriate time horizon. And I think one of the things that's happened in impact investing, really that's been kind of a shame, is that we've basically taken wholesale the traditional fund structure that has a 8-year life with 2 1-year extensions or whatever the frame may be, as the operating structure that we need to have, when in fact we need to be moving more toward long-term evergreen funds and holding companies if we're going to be able to really deploy capital and manage for long-term value as opposed to shorter-term return. And I think that this is, again, part of the conversation that we have to have is how do we shift our understanding of the time horizon that we're investing for and the accountability for that.
Well, I have good news.
Great.
Honor to work with William Fisher today, which is an expert on the education field of measurements. And we have also the honor to work very side by side with a network called TIES. That's exactly on the education. And we are very on spot to understand the correlation of education and racism and these kind of things that affects a whole individual's life. And that is possible through quantification of measurements. So I'm happy to give you that information that yes, INNORBIS works with that. And we are probably one of the few that works with heavy on the social aspect and the whole interaction of that kind of equality aspect.
Thank you. For you, Angelica, given Jed's response, won't we need a set of queries that are related so that the metrics, the measurement indicates relationships among the elements we care about? We speak of collaboration, but isn't that on a hierarchy that is earned and that measurements need to address?
That's very good. Yes, we need to address that. That's very important. Otherwise, it's not a common metric. Sometimes I get speechless because it's really what needs to happen. The mapping of the relationships, the map of the how does the elements are physically operating with. Yeah, I would say that kind of partnership and collaboration inside a kind of measurement system, which is what we, of course, are building. That is the most important part.
Thank you. A simple question for you both, or Jed or Angelica. Can you develop index which can be traded based on this this approach?
That's very easy. I can start. That's very easy because once you've done the quantification and the measurement, you can create anything like ratings and scores and indexes. So I did show one of them in the presentation, which is performing 22% above the comparison in the market. I'm very happy about that, which means that it works. The quantification works, the theory works, and it's not a trade-off. We have seen a recovery in April that was fantastic and above the market. Index is just a collection of information, for example, of companies. The one I showed is in Europe. And I would add, it cannot be just Msci Esg 30 that is only large corporations. No, because the innovation and the solutions we need for sustainability are not on the large companies. I'm sorry. It is on the SMEs. It is on the innovation that has to be much higher than what I told about the only 10%.
Okay, thank you.
Add to that and say that even if you do create these indices and these indexes, to my mind, you're trading on the surface level of exchange. You're not really investing for value, and that's really the issue. I mean, we can create any number of clever products, clever approaches, and clever indexes, but ultimately that's not going to get us where we want to go, and that keeps us in this kind of exchange posture and a trading posture as opposed to a value creation posture.
Yeah. But Jed, let me add to that. You do have a lot of capital today on fixed income, and that capital is huge. I had a question once from a family office saying, should I pull out all the capital to invest privately? And I said, please don't do that. I mean, you cannot just have everything in one basket, okay? So you need to change the operation of fixed income, the indexes, so it will work for us. But you're right, they are not working today.
Yeah, now a lot of my focus on this total portfolio idea of managing all of your assets on an impact basis. So I agree with that. And then when you look across strategies and asset classes, they all look different, but you can manage them with coherence. But I just think some folks are looking for the fix, and I don't know that there's a fix per se.
Yeah. Don't do passive investments now.
Where I'm going to have to start wrapping up. We went way beyond the normal time, but this is a very unique event. Nobody left. All of the people that came are still here. We can't. It's like almost like trying to kick them out of a bar. They're still
Where are they
here.
going to go? They can't
So,
go.
so we're not going to be able to answer all of the questions there within this time frame, but I do want to give you the final word, Jed and Angelica. How can this audience help you?
I didn't think you were going to end with that question. I guess I think people could help me by taking an opportunity to reflect before responding. And I think we're really conditioned to react. We're conditioned, I'm an advisor. I'm supposed to have answers for people. And when you say to folks, look, maybe our first action should be an inaction. There's a Buddhist phrase, don't just do something, sit there. And I think it's important that we take a moment as individuals, as a community, especially in this time, to really pause and reflect and reconnect with the fundamentals of what we're really trying to be about over the course of our lives. Because the capital, profits, the metrics, I mean, these are all just kind of byproducts of how we want to and how we choose to be in the world. And so I would ask that we simply pause and we consider the generations that have come before it, their experience and knowledge, and bring that in to inform our wisdom of today in order to position us best for the future.
Angelica?
Okay. Thanks for that. I would say there is one motive and reason why we are building this and why I got so frustrated and left to build what we are building. And one of the things is a software called INNORBIS, and it's for the next generation. We have a massive generation out there that needs help, and we are a bridge. That's our work. And if there is anybody out there that can collaborate, work with us, be our partners, really drive this together with us, that's what I would love to. Because it's for the children of the world. It's for the ones taking over from the passive investments, because that's not going to solve any of the solutions needed for addressing sustainability in the world. We need to act together. So let's spread the news. Let's say that it is possible. We do have a huge work to do, but we have started. It's been 4 years now, and we will not let go until we're done. Let's have another call, because this one, nobody left. The answers are not.
It's like a bar closing. You can't get them. Once they start drinking, you can't kick them out. I want to thank everyone who's listened. I want to thank Angelica and Jed for taking all of this time, and for all of the people who stayed. We will be doing a private investor salon on Friday for accredited investors. If you're interested, please reach out. You'll get an invitation. Next week's webinar is on climate finance, and we're doing a double header, virtual happy hour, think Tinder speed dating, to meet the most inspiring person in the impact space without ever leaving your home. It's all done on your phone app. Thank you all very, very much. You'll get a mail with the link to the replay so you can rewatch this video. I have a lot of people to thank who worked on the production of this. I want to thank our entire production crew who made this webinar possible. Sam, our producer, DJ genius and ramen critic. Ricky, my absolute better half with no filter. Donnie Trump, our empathy coach. Xi Jinping, head of transparency and integrity. Jair Bolsonaro, Director of Forest Conservation, Kellyanne Conway, who runs our Alternative Facts Department, Boris Johnson, our hairstylist, Vladimir Putin, our Conflict Resolution Supervisor, Jeff Bezos, our Human Resources and Full-Text Compliance Leader, Rodrigo Duterte, our Recreational Drugs Mentor, Lance Armstrong, Lobbyist for Sports Integrity, Angelica Merkel, our Fashion Stylist and Trump Groupie. See you next week.
Thank you. Bye-bye.